I think this is the most important year for Bitcoin that has ever existed. We are probably days away from a series of ETFs being approved. And so this is the moment for Bitcoin to use that old term, cross the chasm and really see mainstream adoption, where our parents and our grandparents understand what it is, can buy it, and then do buy it. And I think that if all of this comes to pass, Bitcoin will be a part of the traditional financial lexicon by the end of 2024. So that is my most anticipated trend of the year.
Welcome back to Money 101. In today's discussion, Chamath from the All In podcast shares his insights on the future of Bitcoin prices and the significant influx of institutional capital into the crypto market. According to Chamath, the upcoming bull run is poised to surpass recent historical trends. The imminent approval of BlackRock's Bitcoin ETF by the SEC is a crucial signal for a massive capital surge into the crypto space. Recent weeks have witnessed rapid increases in cryptocurrency prices, heightening investor anticipation for ETF approvals that could unleash substantial capital into the crypto sphere. Chamath highlights that a mere 1% allocation of BlackRock's portfolio could result in hundreds of billions of institutional dollars entering the market. Anticipating a 400% surge in Bitcoin prices reaching a minimum of $100,000, Chamath points out that this projection aligns with the Bitcoin halving timeline, suggesting a potential record-breaking crypto surge in the coming months. Join us for the full interview with Chamath, where he delves into crypto price predictions, Bitcoin's timeline, and the outlook for the days and weeks ahead. If you find this content valuable, don't forget to subscribe to the channel to show your support.
Where is it going? It's probably going to 100, then 150, then 200,000. In what period? I don't know. 5 years, 10 years, but it's going there. And the reason is because every time you see all of this stuff happening, it just reminds you that, wow, our leaders are not as trustworthy and reliable as they used to be. And so just in case, we really do need to have some kind of, insurance we can keep under our pillow that gives us some access to an uncorrelated hedge. This is now the beginning of the new fiscal year for the entire mutual fund complex. So that's trillions of dollars that have to get deployed, because even though you pay them a very small fee per year, you're not paying them to hold cash. You're paying them to make decisions and own assets. And then, as you said, Friedberg, the last part of this is now you introduce rate cuts, and that's a real accelerant. Now, more than likely, I think what that means is that markets are set up to do pretty well, equity markets specifically. What is all of this saying? I think what it's kind of saying is inflation is very much in the rearview mirror. Rates are going to get cut by the middle part of the year. The economy looks like it's going to be a soft landing. When we were doing a lot of forecasting going into this cycle, here's like a couple of really interesting observations. So the first one is, when you look at this M2 money supply, look how much it's actually shrunk. Now, why that's interesting to me is that you have these two forces that are opposing each other. One is we have these huge deficits, so we're technically still, frankly, issuing a lot of money, right? But then on the other side, we have QT, so when debt rolls off, we're not reissuing it. And the balance of that is still a really constructive thing, where now you can see that, M2 has materially started to shrink. And I think that that's a really positive thing, because now what that does, it combats inflation in a good way. Unfortunately for all of us, it hurts financial assets, which is not so good. I think we've all felt that pain, but the reality is that that's been working. So then, Nick, if you go to the second chart, so what you see now is like, we are in a really decent place with inflation. And if you think about what's going to happen over the next 6 months, it's mostly in the bag. And meaning, we talked about this before, but there's a lag effect on a handful of components, specifically rents, which when you roll them into this inflation rate, you're going to see it really, really turn over very quickly, right? So we know that inflation is falling. It's going to fall even more. The second thing, Nick, the third chart here, is you can see that now validated in these 10-year break-evens. Remember, this was the chart we used to look at when we were like, holy mackerel, something's going to break. In November of 21, I think we probably should have just sold everything we had in November of 21. We didn't do it, but the point is now we know. And what you see here is the 10-year break-evens are also telling us, okay, guys, we're going to be in a pretty decent place. And so I think the setup is basically the following. There's less money in the system. That's a positive. Nick, if you show the last chart, there's more money on the sidelines. And this is just a picture of, look at the amount of money in money market funds. 6 trillion and growing. So that's a really positive sign, which is that money will need to find a home. Even just now, because you're gonna be in a situation where, and I'll get to this in a second, but companies are now starting to perform because they've been able to re-baseline against very, very lowered expectations.
Right. And money managers have to do their job and deploy capital.
And that's something we mentioned, I think, last week, but this is now the beginning of the new fiscal year for the entire mutual fund complex. So that's trillions of dollars that have to get deployed, because even though you pay them a very small fee per year, you're not paying them to hold cash. You're paying them to make decisions and own assets. And then, as you said, Friedberg, the last part of this is now you introduce rate cuts, and that's a real accelerant. Now, more than likely, I think what that means is that markets are set up to do pretty well, equity markets specifically. And so I went and I said, well, how can we see some data that proves that this is happening? And what's amazing is if you look at the performance of what I would call the most risk-adjusted seeking companies, so those are tech businesses that have been absolutely hammered. So what is all of this saying? I think what it's kind of saying is inflation is very much in the rearview mirror. Rates are going to get cut by the middle part of the year. The economy looks like it's going to be a soft landing. It's also good for equities. It's good for us. So it's really interesting, actually. I think we've had a fundamental kind of now change. Can you play the clip in 2012 and 13 when it was at 200 and everybody was laughing at me on CNBC every time I would talk about Bitcoin? Where is it going? It's probably going to 100, then 150, then 200,000. And the reason is because every time you see all of this stuff happening, it just reminds you that, wow, our leaders are not as trustworthy and reliable as they used to be. And so just in case, we really do need to have some kind of, insurance we can keep under our pillow that gives us some access to an uncorrelated hedge. And it's going to eventually transition to something much more important. But for right now, you're just getting all these data points that prove this thing. It's just the fabric of society is frayed. And until we figure out how to make it better, it's time to just have a little schmuck insurance on the side, and everybody's running in. It's just an incredible thing. I could never have imagined it. It is out of control. Like, look, let's talk Bitcoin. Let's talk Bitcoin. 2012, I was introduced to it. I started to accumulate. 2013, I wrote an article.
And so hold on, just so we know we can feel bad about ourselves, you're accumulating it at what price?
Well, my dollar cost average is around 100 and something.
And you've held it, everything you've bought?
Well, at one point, myself and so I was introduced to it by a person. I asked him if I could disclose his name. He said no. But he, myself, and another person, all three of us relatively well known in the Valley, we started, at one point, we owned almost 5% of the entire fleet. In 2013, they've sold, et cetera, et cetera. I wish we had kept it all. We didn't. It's fine. But then I wrote an article and I said, you know what? There's so much asymmetric upside here. This is a thing that either goes to, at the time I said, roughly the value of gold. And at the time it was about $100 a coin. And so there's very little downside. There's all this asymmetric upside. I said, take 1% of your net worth and buy this schmuck insurance. And it's a schmuck insurance in this kind of very elegant, beautiful way.
I missed the schmuck insurance.
That was at $100 though. What would you, I actually started hearing from people that I know very well who don't often invest, who are now asking me if this is the time to invest.
Schmuck insurance now.
Here's the thing. This is now a confidence game, right? There is no real utility in this. This is a fantastic fundamental hedge and store of value against autocratic regimes and banking infrastructure that we know is corrosive to how the world needs to work properly. You cannot have central banks infinitely printing currency. You cannot have folks with, misguided and misdirected monetary and fiscal policy. No. So here's what I would say. The same way that I said in 2013, put 1% of your net worth into Bitcoin, I will put myself out there today. I think this thing is $100,000 a coin, probably in the next 3 to 4 years. And I think it is in the next 20 years, $1 million a coin. So there you have it. What I'm saying is you could buy the S&P 500 index, buy 99% of that. So if you have $100 to invest, what I'm saying is
But $1.
put $1. And the reason that $1 is so valuable is that it is fundamentally not correlated to the other 99. And just on the off chance that all the people that manage the 99 may not totally know what they're doing, the $1 may actually save us.
The cryptocurrency market is on the verge of experiencing a substantial surge in prices, according to Chamath. He emphasizes Bitcoin's current undervaluation, attracting investors and enticing speculators eager to capitalize on the price fluctuations observed in September for potential profits. Chamath's optimistic outlook is driven by the anticipated wave of mass adoption, which he views as an unprecedented opportunity to participate in the market's growth. He foresees a race toward a six-figure price target unfolding in less than a year. Additionally, he points to the historical pattern of Bitcoin's value surging 10 times with each halving event, suggesting a potential jump from $10,000 to an astonishing $100,000 in 2024. Chamath criticizes the Federal Reserve and central banks for hollow promises, resulting in excessive money printing and a proliferation of poor investments. In the aftermath of the recent inflation surge, he contends that a return to the status quo is unlikely, asserting that the economy is spiraling out of control, leading to a mounting U.S. debt crisis. Chamath presents two grim possibilities: hyperinflation or a deflationary depression, both of which would significantly deteriorate overall quality of life. Despite the severity of the crisis, he notes a lack of viable solutions. Notably, Chamath highlights how political figures are now discussing Bitcoin as a potential solution, indicating a shift toward a Bitcoin-centric financial framework. Share your thoughts on Chamath's Bitcoin prediction, the crypto market cap, and the influx of institutional capital by commenting below. Thank you for watching. Don't forget to hit the like button and subscribe for more content like this. Stay tuned for our next video.